Welcome to this explainer. Today, we're unpacking banking on Bitcoin, and we're going to map out exactly what happens when a rogue technological concept literally collides with the bedrock of traditional finance. We'll be examining the fundamental, structural friction between the established global banking system and the totally decentralized challenge it's facing right now. Okay, let's dive into this. When a deeply entrenched institution faces a completely unprecedented type of friction, the resulting shockwaves kind of rewrite the rules of the game. We aren't just looking at a small software upgrade here, or say a flashy new mobile app for your local checking account. No, we're analyzing a fundamental clash of underlying architectures. It's a systemic collision between centuries of centralized trust and a natively digital, trustless framework. Chapter 1, the banking status quo. First up, we just need to take a macro look at the legacy architecture that currently handles the flow of global capital. So the traditional banking infrastructure basically operates on these massive centralized ledgers and clearinghouses that have been built up over centuries. To put the sheer scale of that into perspective, this is a system processing trillions of dollars daily through international networks, and it's entirely dependent on trusted middlemen. But, and this is a big but, centralization carries inherent vulnerabilities. We're talking single points of failure, bureaucratic bottlenecks, and systemic risks that become, painfully obvious during liquidity crises. This is the Goliath of our story. Undeniably powerful, deeply rooted, but fundamentally pretty rigid. Moving right along to Chapter 2, Bitcoin's mysterious origins. Let's shift gears and zoom in on the emergence of a completely different framework. Let's trace how this builds over time. For decades, centralized banking enjoyed totally unquestioned dominance. But then, right in the direct aftermath of the 2008 financial crisis, a technological wildcard was thrown onto the table. When the pseudonymous Satoshi Nakamoto published a 9-page white paper, it wasn't a proposal for a better bank. Actually, scratch that, it wasn't a bank at all. It was an entirely new cryptographic proof-of-work mechanism. Within months, the Genesis block was mined, famously embedding a newspaper headline about bank bailouts right there directly into its code. Almost overnight, unquestioned dominance shifted into an active, escalating standoff. Now, what's really interesting about this is the sheer audacity of defining Bitcoin not merely as a digital currency, but as an autonomous financial system. Think about it. Traditional models assume that money requires an issuer, right? Like a sovereign state or a central bank. By designing a system that relies on a decentralized network of nodes to verify transactions, the originators just bypass the need for an issuer entirely. It's a massive paradigm shift. It's essentially replacing institutional trust with mathematical cryptographic verification. Which brings us to Chapter 3, the decentralized challenge. Let's zoom back out and look at this direct standoff in modern finance. So the crucial point here is just how fundamentally incompatible these two paradigms really are. On one hand, you have the conventional mechanics. They're centralized, heavily regulated, and they rely on permissioned access. On the other hand, you have the alternative architecture, open source, permissionless, and maintained by distributed consensus. They are attempting to solve the exact same problem, financial exchange, but man, they are speaking two entirely different languages, operating on completely different philosophical and technical foundations. And breaking down the mechanics of this fundamental friction really illustrates the core issue without taking a side. The established model draws its strength from historical dominance and institutional authority. But, and here's the kicker, how does history defend itself against open source code? The originating challenger leverages technological novelty, literally turning the lack of a central authority into its primary feature, not a bug. It's a clash between a system optimized for control and compliance versus a system optimized for resilience and censorship resistance. As we step back and survey this vast digital space, the defining question of modern economics really hangs in the balance. We understand the entrenched power of the status quo, and we've analyzed the structurally defiant nature of its decentralized challenger. So what happens next? Will the established Goliath integrate the underlying mechanics of this rogue network, or are we looking at a future of perpetual parallel friction? It's a structural standoff that is actively rewriting the future of money.